Welcome to Option Trades today. I'm Tony the Bat Batista right here in downtown Chicago, right here in the Bat Cave. We're going to come at you with a nice little trade on 1010. The Tesla numbers coming out today after the close, but I'm not going to go to Tesla today. I'm going to do something a little bit different. I'm going to show you something I think is very interesting and a nice way to look at volatility in oil-related products. Hey, first let's take a quick look at the market. Even the S&P is down $13. NASDAQ down $36 and change. Russell, the weakest of the group, down almost 1%, continues to be weak. Down $21 and change, and the Dow down 120. I said just now that the Russell is the weakest of the group, and comparing to some of the other indices, if you take a look here at the Russell E-mini S&P graph, you'll notice here that it's at an extreme. It's about as low as it's been. That's a 1-to-1 relationship between being long Russell, short E-mini S&Ps, or long the Russell stocks versus short the E-mini S&Ps. If you change this to NASDAQ, it will show you the same thing, /NQ. If you look at that, you'll notice that it's almost at the same extreme, not quite as large. I don't have that position on. I wouldn't look to put that position on, but it is interesting for people that are looking for divergences in markets that might think, hey, maybe it's time to buy the Russell here a little bit. I personally don't think it's that time. But there is something to take a look at in oil. Oil up $1.37 today. And you'll notice that the IV rank is quite high here at 89. It's about as high as it's been in recent history here, as the product is pretty much range bound, especially the higher end, up around 82. Now, oil always has call skew to it. And what's call skew? Let's take a look at these November options. We like to go closest to 45 days. The mechanics don't change whether you're trading futures options or equity options. Now let's take a look at what I was just saying a moment ago about, closest call skew, how far you can go from the closest at the money. Let's just say 74.5 or 75 is the at the money strike right now, even though you're looking at the future at 74. That's the one you're trading. Remember, when you're trading futures options, you're always trading the future that's represented in your months. You'll notice right here, this future, the Z4, is trading at $74. The future that's going to go away in about a week, which is still the front month, and that's reflected up here, is trading $74.70. So remember, the product that I'm going to be trading with 36 days to go is trading at $74, not $74.72. A little nuance about futures and futures options. Make sure you're trading the future that represents, or you're looking at the future that represents the month that you're in. And you can notice as oil gets further out in time, it's actually getting lower. Usually you would see something where the front month is lower and the back month has more cost to carry. I don't think that's an anomaly for any type of future direction, but it is something to check out and notice when that's happening. Another thing you should notice about is skew. Let's get back to that. So that the at the money is 74. That's why this line is right here at 74 and not up at 74.5 or closer to 75 if it was showing you that the future was trading 74.72. Showing you that the future is trading closer to 74. That's what that line is here in the middle. That's the at the money strike. So let's go $10 up, just to take a quick look, and you'll notice that that option is trading around $1.60 on the offer. Now, let's try to see if there's call or put skew. You go down from 74 down to 64. All I'm doing is going an equal distance away from the at the money. All things being equal, each strike has the same probability of success to it. But look, the 84 is trading for 82 cents. That means that the 64 is trading for 82 cents. That means the 84 call option has twice as much, almost twice as much premium, even though it's an equal distance away, which means the delta is going to be larger too. You notice the delta here is 24 on the call, and the delta here on the put is closer to 14, 15. So as volatility expands, options get more delta to them. That's why your delta will change when you have a position on that's equal distance away, like a strangle. When volatility expands and contracts, your delta's dynamic. Good way of looking at it. What am I going to look to do here? Well, I'm going to show you one more thing first. I'm going to go to OVX semicolon CGI. Okay, you'll notice that there's no options for this because this is just a crude oil VIX index. What you could do is look at what that's been doing. That's really just showing you what the volatility and, now that I just showed you what skew is, what the skew and volatility is doing in oil. OVX is oil. Don't ask me, the CBOE it's the CBOE product. I don't know why they name it like this, but that's how it is. You'll notice it's about as high as it's been. Yeah, it was higher day 2 or 3, but you'll notice if you're looking for a median or a mean price, you would say it would be around 34 or 35. So there's an awful lot of call skew here. There's typically always call skew in oil, but now that call skew is at an extreme. I'm going to take advantage of that by going back to the well in /CL. I did a 1/2 ratio spread a few days ago. We were able to take it off for a $100 profit. I'm going to go back to that well today, take on a little bit more risk because when I placed the other trade on in oil about a week or so ago, we had more time. We were able to go further away from at the money, and I was able to go a little bit wider. But I still like this trade because it has that high implied volatility and skew. I'm going to go to around I said the 15-ish deltas where I normally like to go. I'm going to go about to the 18 delta. That's taking a little bit more risk, especially with the product being a little bit higher, getting a little bit closer. I'm going to buy one of the 88 calls. I'm going to sell two of the 94 calls. Now, personal preference, typically like to trade the whole numbers. Even though the strike, it's 3 cents wide here, it's 3 cents wide here, it's 3 cents wide here, 2 cents wide here, 2 cents wide here. If all the options have the same width to the bid ask, then I'll trade any one of the strikes. I'll trade the 88 and a halves or 88s or 93 and a halves. Doesn't make a difference to me. But when the options get a little bit wider, the whole number options typically have tighter markets. So as a little kind of thing, I like to go into a little bit of a tighter market. I got filled at 37 cents, I believe. Let me take a look if that's 100% true. Go here to the follow page. Go to Bob the Trader with my smiling face, and I did get filled at 37 cents. I gave you a little bit of a description here going back to the well. See what I did there? A 1/2 omnidirectional bearish ratio spread with massive call skew. I just showed you that massive call skew, but if you don't want to wait to see this podcast, maybe you get a little hint to where I'm going or what I did, and that's always the price there. You can click duplicate this trade right on the tastylive platform. It'll go right out there and populate it for you. But let's go back to that trade page if I can in CL just to take a quick look at some of the numbers. 97% pop. Gotta like that. $30 a day in theta decay because this is almost 10 times the size. It is 10 times the size of a USO. So a 1/2 ratio spread here is really like a $10 by $20, 10 by 20 ratio spread contract-wise in USO. So this is not for everybody, even though it only uses $3,600, let's call it $3,700 in buying power. Your max profit could be $6,370. Let's just round down to $6,000 because you are long this 1/2, long 188 call, short 290 calls, 94 calls, and if, not a great probability, but if we got a pin in oil at 94 and you're still in this trade at expiration, which you would not be able to because you're going to want to get out of this trade a week or so before expiration, plus with span margining, your buying power is going to increase. The closer you get to expiration in time and closer you get to expiration at the money. So if this stock was trading at 94, this buying power can go up, twofold at least. I could check that out for you in just a quick second. I did this the last time. But let me digress for a moment. It's $6,000 because if this product was at expiration at 94, just a skosh under, this 88 call would be worth $6. That's $6,000. This 94 calls that you're short, the two of them, would be worth nothing. You sold it for $370, not 37 cents. That's $370. That's like selling something in the equities at 3.7 $3.70. You can do this in an IRA account if you're so inclined to trade oil products there on the Tasty Trade platform. I don't think you can do it if you're using a different platform. I don't know of any other platform that allows you to do it in an IRA account to be short naked calls. You can be short naked calls in an equity in Tasty Trade, as long as you have the amount of buying power that the trade requires. Let me take a look. What else? Delta here, basically Delta 0. I say this is omnidirectional bearish spread because you'll notice this green line gets to my break even. My break even is a little over $100 here. Now oil hasn't been over $100 and hasn't moved that much in a 36-day period here. This would be about the biggest move we had from 66 to just about 80. That's $14 there, and we're outside of that $14 range here. So I mean, to me, that's why the trade has a high probability of success, $97. But you know what? Nobody knows anything, and nobody wants to sit there with a couple of $1,000 loss while you wait for this to be profitable, unless you have the amount of buying power in your account. Here, as the product goes higher, you'll notice that the mid price gets bid up a little bit, so maybe you can get filled another $10 better than I. What's my profit target on this? I don't know, $100, $150, $200, $300, something like that. This should contract nicely. If oil goes lower, that's why I said omnidirectional bearish spread, because there's no risk to the downside in oil. Oil can go to any price to the downside. Obviously, you just have out-of-the-money calls, so that's going to keep you profitable there. Let's take a look at what I just said a moment ago, how your buying power can change on that $6 spread. I'll just go to an extreme here. I'll buy one of the 60 calls. I'll sell two of the 66 calls just to simulate that for you. That $3,000 in buying power goes up to $14,000. So this is a big trader's product. This is not for the faint of heart or for those in a smaller account, at least not in my opinion. I'll go to at the money, buying the 70s and sell the 76s, 1 by 2. I'm just simulating that same $2 wide spread, and you'll notice that the buying power goes up to about $10,000 from the $3,600 that we had before. So remember, your buying power is definitely going to change with span margining. It's a phenomenon to futures options. It does not happen in equity options. So if you're not familiar with that, please do some research on your own. Check our learning center out, or just learn about it by yourself, or put it on very small, as long as you have the buying power and your account can fit that size. Remember our rules about staying small in your account. But you know what? We take all size accounts here at Tasty Trade. So please open, move, transfer, bring your account to Tasty Trade. Hey, listen, help us keep this content free for everyone to use, no matter what brokerage firm you're using, by supporting Tasty Trade and helping us keep the lights on here.